As a personal investor, how often are you looking at your investment portfolio? If you're a professional money manager, how often are you looking at the portfolios that you manage? That's the question for today. I'm going to argue that no matter what the answer is you have in your head, you're looking at these portfolios too often. Now, I've spoken about cognitive errors and behavioral biases many times. You can check out any of these videos by following those links here. The idea is the more you're looking at your portfolio, the more likely it is you will commit one of these behavioral mistakes and that it will have negative impacts on your portfolio. The fact of the matter is these types of mistakes or these behavioral problems helped us survive on the plains of Africa, but they don't help us financially. One of the problems I see out there is it's just impossible to get away from access to looking at your portfolio and trading. I have a number of videos out there you can check out here in terms of, day trading and fintechs causing problems, and some of the stuff we saw with GameStop and other companies. But when you see people saying things like that, hey, sometimes I'm trading when I'm at the grocery store, I've traded at a traffic light. This only again serves to exacerbate these cognitive errors, behavioral biases. So now, but let's just take a look at a hypothetical investment where it has a 5% annual return and it has 10% volatility. Okay, so if you were to look at this every second, it basically has, just barely over a 50% hit rate to get you to that 15% per year. 1 minute, also 50, an hour, 50, a day, 54%. So if you're looking at your portfolio daily, basically, whether it's up or down for any asset in there or the portfolio as a whole, is a complete coin toss. Okay, the key point here is that over short horizons, well, there's two components, right? There's this return component and there's this volatility component. Over short horizons, you're only seeing the volatility. You're not seeing anything about the return. It's only when you get to these longer horizons that you see the return and you don't see the volatility so much. Now, this, of course, when you're looking at this volatility, this noise over short time periods, it puts you in this mental state. It affects your happiness in a negative way. When you see stocks decline versus stocks rise, you're much more affected by the losses and you're subjecting yourself to looking at them daily or whatever it might be. You're also less likely to take on the appropriate amount of risk. You're going to take on less risk than you should given your current circumstances and your time horizons the more frequently you look at your portfolio. You're kind of in this vicious trap. This isn't directly related to, monitoring frequency, but I just want to make the point that, retail investors, individual investors, professional investors, we all make the same mistakes. Okay, so there's a couple of papers out there. This basically is this idea that you buy the winners right before they become losers, and you sell the losers right before they become winners. And this is kind of chasing performance. Again, retail investors do it and professional money managers do it too. We're all making the same mistakes. Even if you're professional, you're not immune to these things. So again, going back to my original point, I think less is more. The less you look at your portfolio, the less likely you are to commit these behavioral errors and the better off you will be in the long run. Thanks so much for listening.